Simon, I think many people will know him. He has a rich career in banking and digital assets, and he just recently joined AllUnity, where he's now a managing director and the CFO and CPO. And AllUnity, one of the issuers of the, I guess, first issuers of a MiCA regulated like stablecoin, Euro stablecoin. So that's going to be very interesting because now we had like first the bank perspective, then we had like the DeFi integration perspective of how to drive demand, and now it's on to the geopolitical impact of stablecoins and why maybe like the US president is now super keen on pushing stablecoins. But now, without further ado, over to you, Simon. Yeah, looking forward to this one.
So let's do it quickly. I thought, despite the marketing, let's give some insights into the geopolitical impact actually of stablecoins, or how Max has very well phrased it, a matter of national interest. So let's quickly go into the stuff. Yeah, I mean, we know stablecoins are relevant in the crypto space, but to be honest, how should they have a geopolitical impact? Somebody from the crypto space might think it's a bit overdone, yeah, to take the assumption that it's that relevant. But let's take a look. What you can see here is the Argentinian peso. And the Argentinian peso is quite volatile. It was one of the currencies with the highest inflation worldwide. And people used to use all US dollars already as an alternative currency in Argentina. A couple of years ago, people started to discover that they can also send US dollar on blockchain via stablecoin, USDT. And nowadays, in the exchange shops, actually, a lot of exchange shops, almost all of them, accept USDT to receive US dollar. So maybe not for you here in Europe, if you're spending your money on the street for buying a coffee or something to eat, but for people in Argentina, USDT, for example, and also USDC has become really, really relevant for their life, and it's geopolitically for them important. And then we can also look, for example, to other countries where payment flows are not as easy as here in Europe. And we see that already German smaller hidden champions are selling, for example, high quality machines to Africa and getting paid in stablecoins. So for them, it's a way to treat payments in a much more efficient way, and it has true economic value and relevance. And another fact that I would like to highlight, very simple, if you look at the relevance of an economic perspective of the largest stablecoin provider worldwide, Tether, you can see that they made as much profit almost as Goldman Sachs last year, but with only 150 people instead of 46,000, I think, very well paid employees of Goldman Sachs. And if you make as much profit as Goldman Sachs, you're fucking relevant economically, I would say. And on the other hand, this becomes an issue because we have a hugely regulated company as Goldman Sachs that's globally relevant for the stability of the global financial market. And you have a company that has the same profit, probably not yet as systemically relevant as Goldman Sachs, but as I mentioned with examples before, definitely it's systemically relevant, but it's completely unregulated. And that is an issue. Yeah? If you have business in that size and that covers so much economic value, and it's completely unregulated and lies in the hand of a few people, it's simply dangerous. And I think it's scandalous that it hasn't been regulated yet, and it might also not be for quite a while still. I'll come to that later. And now a much more interesting fact, if you look at why, for example, the US hasn't intervened yet. I mean, now we have Genius Act and more regulation coming in. Why is the US government now so bullish on stablecoins? I think it's a fair and valid question. Some people might say, yeah, because now Trump family also builds a stablecoin. That's far too easy. That's far too easy and underestimating the geopolitical impact of stablecoins. Going back to how monetary policy was steered, monetary policy origins because we need to keep the value of a currency stable, independent from government debt. Why? Because historically inflation has always taken place when government, as the sovereign, steers the monetary policy too close to the politics, to the daily politics, and starts printing money. Inflation happens when states print money, as easy as that. And we have established mechanisms to prevent that by giving the monetary policies, especially the central banks, the independence from daily politics, with this back then only and single goal, this has weakened over the last couple of years, of steering monetary policy in order to ensure its stability. And you can see here how this basically is being steered. So how inflation is literally also dependent of the independence of central banks, and Germany doing pretty well here actually historically. So there is definitely a statistically proven effect that a less independent central bank cannot steer the stability of the currency as efficient as one that is more independent. And now, what does this mean with regards to stablecoins? It's important to keep in mind that inflation happens when government is printing money. The US debt right now is at record highs. The US debt is at record highs, and even especially there are some maturities kicking in now, which means the debt must be paid. And if you have short-term debt that must be paid in a environment where interest used to be lower than they are today, refinancing the state becomes more expensive. You have to pay soon more on your debt than you are paying right now. And with rocket high in national debt by the US state and maturities kicking in, there is a high need to refinance quickly. Because if you don't refinance and get out new debt, and the debt actually being sold, you cannot refinance the debt that is maturing, that you have to repay. And now let's look at the market for government debt. Because sometimes we think government debt is something that is just being bought. The state is issuing something and somebody is buying it. But that's not the case. The market for government debt is actually quite tight. And it's mainly countries. Countries buy each other's debts. And so what we see here now is a chart of the buyers of US treasuries. So buyers of the debt of the USA. And what you can see here is the market is quite tight and it's not changing. There are not new countries popping up with a lot of money from nothing that will buy your government debt, but stablecoin issuers are. Stablecoin issuers are a new buyer on an existing matured market that buy government debt. And they distribute it worldwide to people, to retailers, to the people in Argentina that we just have seen. So Tether basically is backed by US treasuries, which means Tether buys US treasuries for the money that they receive by people in Argentina that buy food with it. And now what happens is the US has acquired a new customer within a matured market that wasn't existing before to sell off their government debt. So stablecoins, especially US stablecoins that invest in US treasuries, are something like Klarna for states. It's short-term refinancing for governments. And that is what the geopolitical impact of stablecoins is. Tether becomes a large debtor of the US, thereby they get political power over the US to some extent, and the US will try to accommodate the stablecoins. And now they've designed the Genius Act exactly in that kind of a regime to buy especially US short-term debt. And that's why it's Klarna for governments, because it buys short-term debt especially. So this market is now, as you can see, already relevant. Tether is already a bigger debtor to US than South Korea or Germany. But with the tokenized economy increasingly growing, it will even gain additional volume. And now think about what size of a government debt buyer Tether or other stablecoins can become. It's huge. And basically, it becomes a mechanism to sell off government debt to private people. So, however, this is only one side of the stablecoins, and we see a total different angle to the economic relevance of stablecoin in a much more positive sense. And that's relevance through economic value of actual benefits for retailers or also for private people or especially for corporates. We see now, for example, that there is a market and we get approached by it for corporates that want to pay employees in other countries in euro, especially if they have also high inflation. So for example, imagine there's a company that has employees in Turkey. They can now pay the employees in Turkey with a stablecoin, for example, the euro stablecoin. And people in Turkey will like to have euro rather, because it's much more stable than the Turkish lira. Take huge conglomerates of corporates who do a lot of netting right now in between the different companies. Upfront, it will be possible that they can do these internal reconciliations also via stablecoins, cross-border, much faster and much efficient than today's netting mechanism. Or even far into the future, think about an electric car that's being charged by induction, and the car itself is actually paying via wallet to the charging station for the continuous charging. And the car can do that itself because it has a wallet with a stablecoin on it, and it can pay directly. This enables completely new business models, actually, simply only in this area of charging cars and how they can be charged and how they can be paid and how can people use charged cars in the future. So what is our mission as a regulated European stablecoins? We want to provide a European stablecoin as an alternative to the US dominance. And we want to drive scalable and transparent digital financial processes and making global payments basically then as easy as sending a text message, but still as regulated as other e-money, as for example, PayPal. And this is then beyond only like, for example, Germany and Europe. You can do this globally, but it's a European solution built here in Europe, out of Europe, fully compliant, fully regulated, but also completely open. We are on public chain. We use only permissionless chains. We are right now in the process after our go live of course, also extending it to other chains and protocols. And on the public chains, you can do 24/7 transfers only for the gas fees or protocol costs. And that on an institutional level where we will hold the money only within bank deposits and in the future also high quality liquid assets tightly defined with criteria for the BaFin. So that's us, that's AllUnity, and thanks for listening. Happy for the discussion.
Thank you very much. There are questions. So the first one comes from Christos. He asks, how will the profit of stablecoin issuers like Tether or Unity develop in a low or negative interest environment? I guess this is like the business model question for entities like yours.
Yes, for sure. It depends on whether you are in a regulated space or unregulated space. If you're in the regulated space, yes, it will become very, very tightly. So basically, I mean, obviously your revenues go down. Yeah. The question is, can you make any profits at all? I mean, still in negative yield environments, there are instruments that pay some yield, but it's very, very tightly, and especially on the bank deposits, the negative yield will be handled through. Stablecoin issuers will have to figure out if there are additional business models and products that they can develop on top in order to enable also, of course, transactional revenues. But I think this is something that's not too easy, yeah, because as a stablecoin issuer, I mean, we do that like that. I wouldn't charge for a redemption or an issuance, and we cannot and will not charge for a transfer because we want to keep it free and open. So you have to take some thought into how to provide additional values and products. To be realistic, I think within the next 2 or 3 years, we won't see negative interest rates again, but you never know.
And how can you make Euro stablecoins as attractive as US stablecoins? And I think the observation here is that I guess it refers to DeFi and also to the interest rates on the reserves with the huge yield difference.
I think we have to be realistic. We will not. It's not going to happen. Yeah, it will not reach the same yields as unregulated US dollar stablecoins do right now. But if Tether fucks up, you're fucked. Yeah, so that's maybe something to keep into account, and we have also seen stablecoins collapse. Yeah, so security is something to consider besides yield. Even though, of course, especially in the DeFi world, sometimes this is not in the focus, and also there is a need also for processing payments in euro. I think this comes especially more important when we go closer to the payment side. Yeah, of course, only for holding the stable coins, it will not reach the same yields. But there is definitely a market for euro. We see that in the regular currency space. And there will also be a market for euro within the stablecoin space.
I think I have to take last one because Alex is pressuring me into taking this one with this emoji, I guess. So is the stablecoin issuer business a winner takes it all business? Or in other words, will we see a consolidation of stablecoin issuers?
I agree. I did actually my first academic work around platform economics and especially these network effects. And it's definitely a market where I would say it's an oligopoly structure. Yeah, because ultimately it takes deep pockets and also deep liquidity. So I don't think there will be a market even for Euro stablecoins like for 20 stablecoins in the European market. Yeah, there will be a market maybe for like 5 larger ones that are really profitable.